Hi there and welcome to the latest episode where we're joined by Scott Baldwin, the Managing Director and CEO of Solvar, which is listed on the ASX under the ticker SVR. We chat through the Solvar story fresh off the back of the first half year results. We hope you enjoy. Scott Baldwin, thank you very much for joining us. I think we've probably worked together, known each other for the best part of 10 plus years from a mutual friend and mutual shareholder. So it's great to have you in the hot seat. Thanks for joining us.
No, thanks for the first time, Simon.
Correct, no pressure. Just for those, you've been with the business 18 years. That's quite scary.
Not quite 18. Don't
Wow.
say it that way. It sounds
You're
like a long
almost
time.
you're almost of age within the Solvar business. But for those that don't know the Solvar story, it's had a number of iterations in terms of, or maybe just one in particular, name change from Money3, which the brand still stands today. But maybe if you could just give us a bit of an overview on Solvar and where you play in the lending market.
Absolutely. We changed our name a few years ago, or more accurately, changed the name of the head company because the Solvar Group had acquired interest in some other brands in New Zealand, Go-Car Finance, in Brisbane, Automotive Financial Services. So we wanted a name that more accurately reflected the whole group, not just Money3, one of the brands within the group. Hence the name change. But Money3 is still there and trading today.
And in terms of the last 5 years, maybe if we just talk about how the strategy's evolved. Obviously, you've got the new consumer lending business in terms of Benji, which is a dog, I believe it or not.
It is.
Yeah.
Your finance companion. That was the idea.
Very good. Man's best friend
Yes.
and women. But maybe just talk us through how that strategy's sort of changed over the last 5 years.
Well, if you think of the three brands we have today, Money3, it's focused on used vehicles primarily, but higher credit risk applicants, so people that are wanting to buy an older used vehicle. And typically that approaches to a certain cohort of broker and works with them. We then have another brand, Automotive Financial Services, which is generally a prime or an almost bank applicant credit risk quality, typically buying a newer vehicle, certainly a lot more caravans and leisure products in AFS than there is in Money3, but certainly higher credit quality. And that's evidence, I mean, since we've owned that business, write-offs have been less than 1% of the portfolio, which is a real standout in terms of credit quality of AFS. And over that journey, what we realised was that not having a dedicated commercial team within our business was a challenge, and we needed better commercial products so that if a person approached us wanting to buy a Hilux, they expected a different type of contract if they were doing it for commercial means as if they were a consumer. And we found we were losing that business to our peers, and really from pressure from our distribution channel to find a better commercial product led us to the creation of Benji.
And so when you talk about Benji, who is it, or who was it losing business to, given that you didn't have their offering?
Look, in the Money3 brand, Finance One was probably the biggest competitor we were losing ground to there. And then just generally, as you look at Pepper and other players in the space, because there's a lot of non-bank finance companies today, is where we were losing it. It's more about leveraging our distribution. So when a BDM calls on a broker, he can talk about both product offerings for their customers.
Maybe just step out, you talk about non-bank lenders, and there's a whole lot more of them today. Can we just talk about why that is? Obviously there's the history with the banks, and there's risk around it and whatnot. But why is there such an opportunity today in terms of non-bank lenders and going for that latent supply?
I think over the last 10 years in particular, we've seen all of the banks exit one part of asset lending to focus on mortgage finance. It started sort of with ANZ from our point of view. When the Asanda business that they own, they started to exit that space. I believe it's to do with capital adequacy requirements that the banks have to hold. And that's moved out into the non-bank sector that's been able to create greater levels of leverage through a variety of instruments than a bank can in order to fund those assets. And they are riskier than a mortgage. So that's what's led the expansion of the non-bank sector.
And if we sort of just step it again across your products, you listed three of them. Is there any sort of still sort of potential fourth product, or how do you sort of look at that? Are you happy owning the space that you've got at the moment? Benji's obviously just launched. I think you just announced today that it's hit $10 million and expected to double by Q3. But is there any sort of holes still in the portfolio?
Look, we have an unsecured product, but we've never really focused on expanding that beyond the scope of where it is. I think for the next 12 months or so, you'll see us focus on commercial lending or loans for commercial purposes. But that's sort of the next cab off the rank once we get a decent sort of market presence in commercial asset finance as well.
And we just announced the first half results today, which from a quick look pretty strong. Maybe just sort of talk through your view or the key highlights across those.
Absolutely. Look, normalised net profit after tax returning to $20 million has been a lot of work, and it's we are a beneficiary of selling some of our post write-off loans. So investors should think of those as loans that have been through the cycle, and they are written off our books, but we sold that portfolio in New Zealand as part of our exit strategy there. So it does lift our earnings for the first half a little bit as we bring forward cash flows into this accounting period. But more than anything, it gives us a cleaner exit strategy out of New Zealand. So the sale of the portfolio there has been a real positive, 9.4 million New Zealand dollars for that sale, 8 million up front and the rest.
Were you expecting to get, were you sort of budgeting to get something for that?
Not at all. We had been in negotiation to find a purchaser for that asset for well over 18 months since we announced the sale of our portfolio. And we wanted to get the best outcome for investors. I know there was a lot of feedback from investors to do it quickly, but this gave us a very good commercial outcome for the business, and potentially sets us up for a partnership in terms of post write-off collections in New Zealand moving forward as well, which will just make it easier for us as we look to exit our operations in New Zealand, which should be done over the next 12, 18 months, but really the next 6 months is where the last the last set of big tasks, such as closing the office, relocating staff, is to be done.
You wouldn't do New Zealand again?
Look, I think our challenges in New Zealand, if it was one issue, we could have resolved that. But certainly Victoria's lockdown,
perfect storm.
It was it made it very hard to recruit people when you weren't allowed to leave your home. It was a relatively new business here, and we ended up making some poor hiring decisions. We were funded that business by Credit Suisse, and we had a lockdown. So it was a perfect storm of challenges, and New Zealand persists with just a variety of issues that we think we can make better economic returns here in Australia. Hence the decision to focus on
just simplify.
Simplify.
Focus on their own backyard. And in terms of the further highlights from the first half, just run through those.
Look, one of the things that I think is encouraging, we had a really slow start. So the first 3 to 4 months of the year, our loan book went backwards, lending went down, sort of coinciding with the decision handed down by the federal court, the judgment. The federal court handed down the findings in September of 25, and since that point in time, staff have been able to focus on the future rather than the past, and we have, plus it also coincided with coming into Christmas, and that's where we saw quite a strong turnaround in terms of lending volumes, not just in Money 3, but also AFS. And more encouragingly, a lot of that came from returning customers, people that have borrowed from us in the past, which is typically what we see over the Christmas.
And that was going to be one thing that I sort of focused on more broadly in terms of returning customers. And for years, probably a decade or more, you've talked about your customer care team and how important it is. Maybe that's sort of an intangible that probably investors maybe don't care about, but is very important to the business. Maybe just talk a little bit about that and why it's so important.
Yeah, a lot of businesses in our space don't have their own internal customer care or collections team. They outsource that to a third party, where we've tried to build that as a strength of the business, given that a lot of, particularly Money 3 clients, are higher credit risk than a typical borrower. These are salt of the earth people that are looking for a used vehicle to get from A to B. So what they need is someone that they can talk to on a regular basis about their payments. We don't try and take the same payment every day, every of the week over the whole life of the loan, because for a lot of people that doesn't work for them. So a lot of what that customer care team does is, in conversation with the customer, try and align the repayment of the loan with affordability so that they're not missing payments. It works for them and it works for us.
Or when they've got excess cash, they can pay a bit more and that sort of thing.
That's right. And if you look at that July, August period, which coincides with tax time, we have a lot of people that will ring in and say, I'd like to pay a little bit extra off my loan. And given that there's no penalty for early payout in a Money 3 loan, it's a real benefit to them that they can align the repayment of the loan with their with their income circumstance.
And if we just talk to risk, you talk about higher risk clients, and that goes with the style of the customer or the borrower. How do you sort of manage that, and how has that sort of trended over the last few years?
If you look at the announcement we've put out recently, you'll see that there has been, since COVID, there's been a slight deterioration of performance, but in the last 6 months you'll see that start to come back again, particularly the good payers in our books. So that's people that might have missed one or two payments but are still principally trying to keep up with their overall commitments. That has actually improved over the last 6 months, which I think is in line with what we've seen in the economy, where strong economy, plenty of jobs that people have got there, notwithstanding the fact that there is cost of living challenges everywhere, and we see that in new borrowing more than anything. But if I look at the last 6 months, it's one of the strongest 6 month periods of cash collections we've ever had.
That's push.
We've had a lot of people trying to make extra payments. We've had a couple of larger loans pay out, and this is people telling us that there's two reasons: deleverage, customers wanting to pay off their loans, plus competition. There's certainly been a lot of competition in this space as well.
And dividends, that's been sort of good news story for yield and whatnot. Just talk us through what that sort of looked like from today's announcement as well.
Yeah, absolutely. Like we've recognised, and we've got a lot of feedback at the AGM last year from shareholders around dividends and the company holding a lot of franking credits, considering it's been profitable since listing in 2006. And shareholders would be aware we've had, because the dividends are part of a wider capital management strategy. So when the business was trading below net tangible assets, we had a share buyback in place. We bought back a number of shares, which has improved the net tangible assets of the business. And if you look at this period of time, the cancellation of those shares have lifted the earnings per share by just under 1 cent for every shareholder that's on our register today. That coupled with the fact that we have sold part of our post write-off book in New Zealand, allowed us to pay a total of 11 cents in dividends for this first half, and that's made up of 5 cents of special dividends, which is a result of activities happening in New Zealand, and 6 cents from our normal operations. So 11 cents for the half. Pretty strong, fully franked dividend for investors.
And in terms of, and I think we've talked about this over the years, but now, touch wood, we're out the other side. Post February, with ASIC, they've already had handed down their findings and whatnot. How attractive? The market cap's 300 million odd. It's obviously paying a pretty good yield on that. How attractive would Solvar be to an acquirer?
Look, I think it's a very attractive business, because unlike many of our peers, it's actually relatively low levered, which makes it a less risky business, because a lot of the portfolio that we have is funded by equity. There certainly is an attractiveness to that. That's part of the reason why the dividend paying ability of the company is higher than many of our peers. I think the biggest issue we've had in terms of that valuation and shareholder interest has been the concern about regulatory matters. Now that they start to be in the rear vision mirror, then that's a possibility. Rate cuts, rate hikes, all the rest of it. Can we just, I think it was probably 2 years ago when it just sort of got bit on the bum with that. What happened then, and what's sort of happened since in terms of protecting that? That's a great question, because I think there's a lot of confusion around that. There was two issues, and I think the biggest issue the business had to deal with is to improve our cost of funding. We refinance most of our portfolio with Credit Suisse, and if listeners aren't aware, Credit Suisse went under, which caused millions of dollars of expense for us as a borrower from them to refinance. What we've done now is, if you look across our portfolio, there are warehouses aligned to each brand, and those warehouses typically have more than one funder in those warehouses funding our portfolio.
Diversified.
Yeah, so that diversified funding has been very important. And then, the other part, particularly in the Money 3 business that had been principally equity funded for a long time, that was why we didn't hedge against the movements in interest rates. So that just caused some pain in terms of increasing funding costs as that business grew.
And in terms of sort of market positioning, we talked about Benji, we talked about AFS in New Zealand, out of New Zealand. A lot can change in a few years, but how do you sort of look at Solvar as a whole in the next 3 to 5 years in terms of from a market position?
Look, business is challenging, and if you look at the Solvar business, it's been around for some 25 plus years now. Over most of that, ever since listing, it's paid a dividend every year, every 6 months over that journey. We have had some challenges. The issues with ASIC have been a headwind for the business. But I think what investors should look at is the longevity of the business, the systems and processes in place that have set what is a relatively small market cap company up to take a bigger market share out of this space. And if I look at consumer and commercial finance for vehicles, I don't see banks rushing back into the space, which leaves two principal players in this large $50-odd billion market, and that is non-banks like us. And we're not the biggest, but we're certainly in the top quarter of players in this space, and OEMs are the other ones, which generally fund new vehicles, your likes of Toyota Finance, one of Australia's biggest financiers of automotive of vehicles. So I think we're well placed to be that specialist provider of finance for older assets or slightly more difficult customers that don't fit the mould for businesses that want instant turnaround and instant finance. As soon as there's a challenge, people get knocked out, and that's where we can turn them around quicker than most of our peers in that space.
And so you've been with how long have you been CEO for?
I think it's a good question. I think it's 9 years now.
So 9 years, with the business 18 years.
Yes.
How do you feel, and this is probably more a personal question, but in terms of staff, leadership, and maybe if we start with staff, how's that sort of evolved? It's almost like a different generation has come into the business. How have you sort of handled leading that?
Yeah, absolutely. I mean, I think when I stepped into the role, there was some 480 staff in our business. There's around 280 today, and the business is materially bigger than it was then. So what we've done with the business is try to leverage technology to automate as much as possible, and use technology as an enabler for staff to be able to achieve more in the day.
Yep.
It has been crucial that core 20% of our staff or thereabouts have stayed with the business for that whole journey. They've learned. That
says a fair bit.
It does. It certainly the leadership team has been in place, most of them over 10 years. With the advent of commercial, we brought in a brand new executive into the team to make sure that we had fresh thinking coming into the table as well. But I think the longevity has just been people like being able to provide a service that is not provided by everyone. Customers like the fact that they can call and typically talk to the same person because of what happens with our call routing in the background. I mean, we only have around 70,000, 80,000 customers, so we're able to route a call generally back to the same, the
right person in the relationship.
Yeah, and they can build that relationship with people as they talk about their repayments. But this is not the same company it was when I took it over. If people have followed that journey, we started that with splitting the business in two as we exited and sold our branch network off. So the first 3 years was a material amount of change as what was what was the reason for Money3 existing was what we sold back to the founders, along with a complete change of distribution, moving that all online, no bricks and mortar branches, and moving it to online broker, and more recently point of sale distribution through dealerships as well for the AFS brand. So,
because I mean, one thing I've always sort of thought or seen, there's always been something that sort of popped up, whether it's the branch network, whether it's SAC, whether it's ASIC. It must be it's good fun, but it must be hard to not keep going, but like share price takes a hit. Obviously, investors aren't all that happy when things don't go well, but obviously we sit here today, much stronger and better business for it. But how do you sort of stay the course? It's a good part of your life, really. You're only 40, obviously. But how do you sort of stay positive when you're going to have to go through the shit, really, at the end of the day for 12 months to get through a SAC exit or whatever it is to be a better quality business?
This business listed many years ago off the back of my uncle accounting practice, getting every family, friend, cousin or person I know from regional Victoria to become a shareholder. So I don't get to go to any family functions without people talking about Solvar share price and knowing that a lot of people have put
hard earned.
Put a big part of their savings into this. Also lucky enough to be a large shareholder of the group. And if you look at I think we worked it out just before the AGM that 1 in 5 shares in Solvar today is generally owned by employees or directors of the business, and that's that's people that have worked or been close to the business that have taken the effort to invest, and I get a big part of that as we benefit of Ray Malone's support. As chairman for a while, as a large shareholder in the business today, but so are hundreds of other staff, family, and friends that we've told the story to, and have benefited from this being a dividend-paying stock through the whole journey. And frankly, we have. I think when I joined the company, the share price was around 38 cents. So I know at $1.70, $1.80, there's still more work to do. But
and there's also been dividends paid out as part of that, though.
Yeah.
It always helps having invested interest in terms of knowing that you're going to go to the barbecues, you get whacked on the head. So you got to win together as a team. It makes a big difference.
Nothing better than staff giving you a hard time when the share prices come off, and then being able to talk to what benefits them as well as all shareholders as well, because hundreds of our staff own stock in the company as well.
And in terms of for the remainder of FY26 and maybe the next sort of 12 months, what are the key strategic objectives or priorities as a business?
Look, Benji is often flying, so we're excited about that. We think by the end of March that loan book should double, which gives us some momentum to replace the revenues that have come down a bit as a result of closing New Zealand. But that's growing. AFS had in the last 6 months, 5 of those were much stronger than they were last year. So its momentum is picking up. It's been good. And with the funding deal that we did in the middle of last year, not only did it provide diversification and a new warehouse, but that competition has improved our cost of funding as well. So when I look through to 27, I can see improved cost of funding. I can see a bit of momentum coming through. And I don't think anyone should underestimate just how people feel when they come to work, not having to
overhang.
Not having to consider what they read from consumer advocate sites and others about the regulatory matter. I mean, people want to provide a service to our customers that get them from point A to B. I mean, that's
a critical thing.
It is. It's not just about the money. It's about for people to be able to get access to a motor vehicle to get around, whether that's home, work, or school. That's the benefit that we're getting, and we know that for many of our consumers, particularly in Money3, there aren't a lot of choices in that space. So we do think it's a very worthwhile and valuable product, not just for us as shareholders in the company, but for the community as well.
No, very good. here's to another 18 years, more dividends and capital growth. Well done, Scott. Thanks for catching up.
Thanks, Simon. Look forward to it.
Cheers.
Thanks.
Oh, that was awkward.